Hi there. Welcome to our new question of the week. And this week's question has been asked by a client, which is how are the new PWP portfolios performing so far this year? And so just to introduce that, so the Permanent Wealth Partners portfolios are bespoke model portfolios that we have effectively designed for our clients. And the key reason why we've come up with this is we looked at the offering based on what is available today, and we thought, frankly, it's either too expensive, it's too clunky, it doesn't reflect the views that we have. As you probably know, we've got a long history of working in investment markets and have built up a huge amount of experience and understanding of financial markets over the years. And we felt we wanted to put a portfolio together for our clients that best represents effectively our view, with the overriding factor of keeping charges as low as possible as well. So if we just take a look at what these are looking like so far. So this slide here shows you the range of different portfolios and their performance over the last 5 years. So the PWP 100 is effectively 100% equities, and then the 80-20 is 80% equities and 20% non-equities. And then you can see the range go down from there to 60-40, which is a traditional balanced metric, to effectively the 100% non-equity portfolio. Now, the interesting part about this is that the non-equity component is not necessarily meant to be the growth driver of the portfolio. It's meant to be the stabilizer. And the reason why we've come up with this part in there is, unlike the traditional portfolios, which just has bonds effectively as their non-equity portfolio, if we've learned anything over the last couple of years, is that the idea that bonds are safe, in inverted commas, and don't drop in value is completely and utterly false. As of last year, up to October last year, UK government bonds were down 30 to 35% across the board. They were disastrous as far as offsetting risk. What we've come up with is effectively a basket of assets ranging from, there are some bonds in there, but there are infrastructure assets, there are commodity assets, there are gold assets, there are other inflation-linked bonds, there's some credit, all sorts of different asset classes where we diversify away what we think the traditional bond-based risk, and that portfolio acts as a stabilizer set against the equity component, which really is the growth driver of all portfolios going forwards. And you can see there that over the last 5 years, our 100% equity portfolio, which is the kind of the flagship, is actually just about to break out to new highs, which we're really pleased with. If we're moving on, this is a comparison of our 100% equity portfolio against some other peers. And the other peers are IA Global, which is effectively a global equity benchmark, and then a range of other model portfolio providers. So Quilter run their Wealth Selective Active, HSBC, Vanguard, Legal and General, and then FE Analytics run a long-term what they call high-risk portfolio. And so what we've done is compare, again, over the last 5 years, how our portfolios have compared against what is also available in the same risk category out there. And as we can see, we're really, really pleased that they've actually done really, really well. Moving on, this is actually over the last 12 months, and you can see there that in the last 12 months, we're not actually the top performer. We miss out by 0.02% to Vanguard, but again, we're up there and we're doing very, very well. Which we're really pleased about. As we go down, this is an example of the balance, so the 60-40 portfolio, and we put this against sort of other peers of other type of traditional balance portfolios out there. So you've got HSBC, Vanguard, and Legal and General, as well as a benchmark, which is the mixed investment 40-85%. You can see the kind of that we were able to capture the good gains coming through out of 2021. And then with the sell-off that happened through 2022, yes, it chopped around, and yes, it hasn't done a lot in that time, but we've effectively, instead of other portfolios which have fallen and then are finding their way back up, our falls weren't anywhere near as steep. So we're really pleased that our hedges effectively and the offsetting parts of those portfolios really worked very well. As we look through the rest of the slides, another example here is our 80-20 portfolio, again, still just doing particularly well. So I want to just summarize in terms of the PWP portfolios. We're really pleased with them. The key part around it is the fact that they are low cost. So the portfolios range in cost between somewhere between 0.11% to 0.14%. And then the other difference is, unlike these other competitor portfolios, we don't charge a management or an administration charge on top of that, because we only offer these portfolios to our clients internally. And so if there are any administration charges, we count that. They are covered by the advisory and service charge that you already pay. So hopefully that's answered your question. The permanent wealth portfolios are performing very well this year. If you've got any questions and want to get in touch, or have any want to learn more about them, please get in touch on this email. Thanks. Speak to you soon.